Hi, this is Paul with a market update. And in this market update, I want to show you three things. And the first thing that I want to show you is something that I came across in my various news readings, which is the number of mentions by managements meaning like CEOs, CFOs on conference calls. You might know this. However, most companies hold a conference call at the end of every quarter and discuss what's going on in their business. And if there was an economic recession, what you would start to hear is people would start to worry about it. And you would start to hear people talk about a sales slowdown and a recession that's coming. And in this chart, you'll see that mentions of a recession are virtually nowhere in anyone's conference calls. So even though there's a lot of concerns that the stock market's current decline is pricing in a recession, thus far anyway, the people that actually manage their businesses are seeing no sign that their customers are behaving in a way that suggests that there's a recession coming. And during a recession, what happens is that people stop ordering stuff, they start hoarding money, and in general, there's just a reduction in the number of people willing to buy and economic activity in these various companies. The second thing that I want to show you is that the sentiment indicators, and this is taken from a CNN gauge, which uses a lot of different things, including volatility indicators, the spreads between debt, put call ratios. And I'm not going to go into all of these. Just know that sentiment indicators essentially try to measure whether people are really greedy, meaning like they're all in for huge gains, which usually represents a top. And it represents a top because in terms of the supply and demand, the short-term supply and demand for stocks as an absolute commodity, everyone's sort of all in. And now when people come to sell, there's no one to buy. And so that causes stocks to go down. So if you look at this chart, you'll see that we're really almost, if this was a gas tank, we're full up on fear. We're nearly full up on fear, and we've been full up on fear. And that usually represents something close to a bottom, near a bottom, rather than a top. Bottoms usually are a curved event. It's rarely a single moment. There's usually pieces on there, and each single stock sort of bottoms at a different cycle. However, sentiment, and that's representing the emotional nature of investors, suggests that we're at a fear point, which is usually representative of bottoms. Third, I just want to say that if you've been in the market for a while, let's say, you were lucky enough and you bought in 2009, you'll see this third chart. There have always been worries. When we first started to rally, when this bull market really began, people said, this bull market doesn't deserve to be going up. We've gone too far, too fast. Then once it had gone up for a while, there were issues around Europe and Greece. And then there were issues around China and their growth. Then there were issues around interest rates. When the Federal Reserve first was talking about raising them. And then we went through a number of European episodes around the European Union, if it was going to last, if the euro was going to last. And then in 2015, there was a pretty brutal decline of over nearly 15% or so when the Federal Reserve first started to increase interest rates. And today we have trade wars, interest rates, inflation, and just general fear. Driven by the fact that everyone else is fearful. And this is in some ways the opposite of a mania. In a previous video, when I was talking about Bitcoin being a mania, I said that the essence of a mania is where people want to buy because they hear of everyone else making a lot of money, and the fact that Bitcoin was going up, and that's what's driving them to buy. In a panic, you have the reverse. Everyone sells because they see the market's going down and they feel that everyone else is getting out and they should get out. At some point in time, this burns itself out. And within the current structure of the market, we also have various circuit breakers, which won't allow the stock market to go down more than a certain amount per day, and that acts as a sort of emotional check. We also have consistent buying by 401k plans. Most people are self-enrolled into 401k plans that represent buying on a regular basis. So there's always some amount of buying that's going on. So I believe at some point in time, this selling is going to burn out because as far as I can tell, there's no factual reason for it. It does look like we went through a period where a lot of people bought in and they were clearly unprepared for any sort of a market decline, and they are selling en masse all at once. And what happens in the stock market when you want to do that? It's a little bit like everyone trying to get through one door at the same moment. And at that point in time, the only buyers are really these very large hedge funds or the institutional buyers, which are investment banks and market makers. And they are going to dictate a very low price to you, and you're going to get a terrible price. Most times this has been an opportunity to buy, and if you're willing to sit through it for 6, 9, 12 months, this has been an opportunity to make money. So that's my market update for today. I'll try to make more of these and put these up in my YouTube channel. So until next time, this is Paul Mampilly.